Good to see you. Thanks for coming in. Maverick, it's good to see you. Always good to see you. If you have questions as we go ahead. Please type them in the questions area. We'll be happy to kind of talk about them, all that kind of stuff. Thank you, Maverick. As you might be able to tell, I have a little bit of a throat thing, but I'm getting better. So we're going to go ahead and do it anyway. So Tushar, are you ready to go?
Yes, I am.
Okay. Very cool. Let me go ahead. We're going to start with a legal disclaimer, as we always do. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell any securities, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading securities. MetaStock, the Traders Forum LLC, and their employees disclaim all liability for investment decisions by investors based on the use of the software, any trading strategies, or any information provided in connection with the companies. MetaStock Traders Forum and their employees do not endorse the purchase of a security, nor are they paid to promote any security. No information contained in the presentation should be construed as an investment advice or the solicitation to buy a security. So there you go. There's a legal disclaimer. I do want to talk a little bit about my friend Tushar Chande here. Tushar is actually somebody that I've been well aware of before he called me a few years ago. Do you remember what year you called me? Was it before or after the pandemic? I think it was
just after the start of the pandemic.
After the start, okay. So
2021, I guess.
But I've known of Tushar Chande from his work for a number of years because of all the work that he did with Stochastic RSI, the books that he created, and just probably a technician's technician is how I would refer to Tushar. So, Tushar, can you kind of tell me the names of the books that you kind of written?
Yeah, I've written my first book was A New Technical Trader with Stanley Kroll. Then I wrote Beyond Technical Analysis. We talked more about systems. Then I had a second edition of Beyond Technical Analysis, which I wrote by myself. And then I've written another book called Wealth Management in Retirement, for retirement planning. If you wanted to, how would you manage your assets in retirement? Because when you're working, you're accumulating assets. And after you retire, you're de-accumulating assets. And how do you deal with that?
Can you tell us a little bit about how you got into trading?
I got my PhD when the great bull market in 1982 was starting, so that tells you I'm pretty ancient. And I, of course, had no idea about how the markets work. So I said, I got to learn something about this. So I started learning about it. And then since I come from a quantitative background, I realized that some of the indicators could be updated. So my first major publication was adaptive moving average. So I was the first to invent adaptive exponential moving averages. And I did a number of publications. So in that process, people got to know my work. Then they approached me and said, would you manage money for us? And then that's how I got into the whole trading. But I got it more in the money management business. So I was a CTA for a long time, like 20 years. And then I had a hedge fund and so forth. So I did a lot of sort of trading or managing accounts for banks and high net worth individuals. Trading the futures markets. So that's primarily my background. That's where I come from. And I'm also a systematic trader. So I traded a system without any deviations for decades. And that has its own problems and challenges. And then, so I'm more of a position trader, breakout style trader, and a longer term trader than today, simply because the technology was different back then. But that's sort of how I got started, primarily by doing research and publications, and then getting a chance to manage money.
Cool. All right, cool. Let me ask you this, and this is we can kind of go really quickly through, but just in terms of just some yes/no answers, when you're trading, do you use any type of fundamental analysis, or is that strictly technical?
For me, it's strictly technical. So it's essentially. If you look at the time frame for how often the data are updated, clearly fundamental analysis of the fundamental data is updated far less frequently than technical data. because, for example, if you're using a daily chart or a 5-minute chart, the information gets updated on a daily basis or a weekly basis, whereas fundamental information generally gets updated on a monthly or yearly or quarterly basis. So I just, and there's a lot of lack of precision in the data. When you look at fundamental data, like, for example, if you say value, well, what do you define as value, and so on. Whereas if you say calculate the 50-day moving average, well, everybody has the same data, everybody has the same value for the 50-day moving average. So in that sense, I prefer the precision and faster updates of technical data rather than fundamental data. So I just use technical data for my analysis.
Do you try and time your trades around earnings?
I'm sorry, around earnings?
Yeah. So if there's earnings coming out on a stock
Right.
that you like,
yeah, I know.
Do you wait?
I mean, NVIDIA is a good example because I'm sure their earnings are coming on the 20th or something like that. And, there's a plus minus 10% probability or a move could be plus or minus 10% for NVIDIA around their earnings. So so I typically ignore earnings, and sometimes it helps me, sometimes it hurts me. But generally, the problem is that there are a lot of short-term traders who are trading just intraday or on a 1 or 2 day horizon, and obviously they love earnings because they can go in and out on an intraday basis, or they can trade before the market opens, so they have an advantage there. But I think that longer term, if you do hundreds and hundreds of trades, you might be better off just ignoring the earnings data. But I'm fully aware that you can definitely have tremendous adverse moves against your position. So I guess if you are a small trader, I would say it probably makes more sense not to have a position. But remember that there are tax consequences to getting out of the trade, just to avoid the volatility around earnings. And then the volatility could go in your direction, then you're giving up a big move, and so on and so forth. So it is a tough call, but I think if you have a longer term horizon, you can probably live through the volatility.
Okay, very cool. Let me, another question that I had, a lot of times when we've done webinars with you in the past, you kind of talk a lot about sector rotation and sector analysis. I'm kind of interested in terms of how much that plays into your selection process. When you typically find a stock, how did you decide on a stock, for example? Do you typically look at the broad market and then the sectors and then kind of narrow down that? What's kind of a general idea of kind of the way that you pick out stocks when you're trading?
Right. So you've raised a very interesting and important point, and that point is that we're looking for a needle in a haystack. So if you think of an exchange as a haystack with 5,000 stocks, and of course none of us has an account size that large. So your problem is, what should I trade? And my answer to that is I use the Chande trend meter, which is one of the indicators on the platform, and I do a scan and I rank the say stocks in a group, whatever subgroup you choose, whether it's a group of ETFs, whether it's a group of sectors, whether it's a group of say all the stocks in the S&P 500 or all the stocks in the Dow 30 or whatever index you want, then you can rank them by the Chande trend meter. Then when things are trending, everything will have a value of 100. So I look at the one, but so your problem is at some point you still have to use something else. So I have to use multiple indicators, but I look at say raw returns, and I look at the trend meter. So for example, if you say a stock had a big move, the raw returns are very high, but it's selling off. So then the trend meter would be very low. So there's no point in me taking a position in a stock if the trend meter is low, but it has a high, say 12-month return, because doesn't have the short momentum I need. So the short answer is use a trend meter. If you are a new trader, or if you want to sort of reduce the size of the envelope, the number of stocks that you need to think about, just look at the trend meter values, rank by trend meter, and if there's something at 100 and something at 90, you're better off trading something that's at say between 90 and 100 rather than between say 20 and 30.
Here's another question, completely different direction. How many indicators do you think you've designed over the years?
Dozens and dozens.
Oh, okay.
It all boils down to momentum. So if you think about, can I show you a screenshot?
Yeah, for sure. Yeah, I'm gonna go ahead and stop sharing my screen. Let me know.
How do I? Okay, share screen, right?
Right.
Public screen sharing.
Yep.
Okay. Entire screen, and I don't know if I'm successful with this. Can you see this?
Not yet.
Oh yeah.
I think it's still coming. Actually, no, it's probably here. I moved the kind of the view a little bit. No, I'm not. I don't see your screen just yet.
Oh, sorry.
Oh, you're fine.
I'm not good at this. What do I have to do here?
So instead of here, nice.
Okay, do you have it now?
Yep, I see the.
Okay, all right.
Yeah,
now?
Perfect.
Okay.
First try.
All right. I feel better already. So I don't know. Okay, so here what I've done is I've tried to. So the lower half is Apple. So we all know Apple was selling off, and then it rallied, and now it's sold off a little bit. And in the upper screen, I have 3 different indicators. So the blue line is the Rahul Mohinder oscillator that I know you love. Then the red line is the Chande trend meter, but I've changed the scale to +1 from +100 to 0 to +100 to -100. So it's the same indicator, just on a different scale. Okay. And then I have something called a long-term stochastic RSI, which is the black line. And if you just don't know what's happening, there's just 3 momentum indicators. You see that they are measuring roughly the same thing, but they're reacting to it at a different speed, right?
Right.
Mm-hmm. So if you look at, say, the red line here is the is my version, is the basically the Chande trend meter, and it's above 50. So you see that the stochastic is responding faster, and it's coming down faster. And the Rahul Mohinder oscillator is somewhere in between. It's something like the long-term stochastic RSI, but on the downside, it responds faster. On the upside, it responds slower. I don't know the math underneath, so I can't tell you why, and so on and so on. So the bottom line is that okay. So here the upper screen, this is the Chande trend meter on the usual scale from 0 to 100. I have lines at 80 and 20, and this is the NVIDIA. So when you think of a trade, you have to think of 3 things, right? The first is entry point. So you need to have a specific entry point. It could be a 100-bar breakout, or in my case, it'd be a value near 100, right? Once I'm in the trade, then the only thing that matters is where do I get out. So I have a trailing stop, and you can have different types of trailing stops. So essentially, to answer your question, you sort of have to balance the speed of entry versus the speed of exit, right? And that's kind of what I've always tried to do, is find the balance between the speed of entry and the speed of exit. So if you think of entries and exits, you can enter early, you can enter late, or you can exit early and you can exit late on any given time frame. And typically, fundamental analysis tends to be early to give a signal, and it's late to exit. Whereas as a trend follower, I'm relatively late to enter and late to exit. And so on. So it's just how you want to combine these different variables. Okay, I'm going to stop sharing the screen for now.
Okay. Can you tell me what this TOPS cola means?
Oh, thank you. Now, to go back to where I started as a trend follower, because in the futures market, there's no such thing as fundamental value, and there's no such thing as core value. So TOPS cola stands for take our profits slowly, but cut off losses at once. So that's TOPS cola. Now, let me give you a sense of perspective. So if you look at the annual returns for Berkshire Hathaway, I mean, clearly one of the most successful traders of all time, maybe ever. If you look at his distribution curve, he has very high returns, like triple-digit returns on the positive side, and he has strong double-digit returns on the losing side. So it's kind of a roughly symmetrical curve. Whereas as a trend follower, I cut off the downside. So because I have a trailing stop, I retain the open sort of possibility of having many long trades on the upside, but not too many trades on the downside. So I want to cut off my losing trades and let profits run. So that's TOPS cola. So if you think of the distribution of trades for a trend follower, you'll see that most of the trades on the downside are short-circuited at 20% or 10%, or whatever your value is. but you'll have a few years with 60% returns, 70% returns, and that's really what affects your long-term performance. So top scholar is basically the trend following philosophy of take our profit slowly. So if you have a big trend, you let it run, but cut off losses at once. So if the trade goes against you, you cut it off. So if you look at the sort of the frequency distribution of the trades, you'll see that there's a very sharp cutoff. Or if you look at monthly returns, you'll see there's a very sharp cutoff on the downside for any systematic trend follower.
Do you, so in terms of stop methods, I saw on the chart, I said the Kroll stop. I think that was one that was developed by Stanley Kroll.
No, it was designed by me, but
Okay.
it was in the book that I wrote with him, so his
Okay.
name gets attached to it. But essentially, it's a volatility stop, but you take the highest high value of the volatility stop. So the volatility stop tends to drift away. Let's share my screen again.
Sure.
Can you see it?
Not yet. Not quite yet. I keep moving my screen a little bit smaller, though, so I can kind of look closer to the camera.
Somehow it's not.
I think there's just
it's saying it couldn't capture the device. Okay, it doesn't matter. Anyway, what I'm trying to say is that suppose you take let's just use daily data and look at 100-day high. So if you look at the 100-day high, you can subtract the sum multiple of volatility. Let's say you multiply 5x or 6x. As the volatility increases, the stop will get further and further away from your highest high. So then you don't want to do that. So you take the highest value of the stop. So you get something that moves in tandem with the the price channel, and that's how the Kroll or the Kroll Chande stop works. And the idea there is that you want to take the emotion out of exiting a position. So that's the beauty of having a trading stop, where you don't have to decide, is it the right time to get out? Is it not the right time to get out? You say, well, I hit my stop, I'm out. So I think it's a lot easier to manage the emotions of trading if you have a systematic approach, and the trailing stop has to be part of your sort of combination of entries and exits.
Now, I know based on the systems that you designed, because we've worked on quite a few of them. Actually, you worked on them, and I just looked at them and I admired them afterwards. But I know that if you have a bit of a longer term horizon, you have a little bit of a wider stop. Whereas if you have a shorter term, or if you're looking at maybe a reversal signal, you have a little bit of a shorter stop. Are all of the stops you use based on the Kroll stop?
No.
Okay.
They're all no, not at all. So one of the so as a system designer, and particularly as a CTA when I'm managing money, I spend a lot of time thinking about entries and exits. So I've designed lots and lots of entries and exits, and the way I approach exits is I try to think like a discretionary trader. So I always use multiple exit strategies, and they're all adaptive exit strategies. They're adapting to the market in some way. Either they're adapting to the time in the trade, or they're adapting to the changes in market volatility. And the idea is that one of the places where discretionary traders have a big advantage over a system trader is they can often get much better exits. That is, they can often exit closer to the end of the trade, that is the lowest low or the highest high achieved in the trade, than a purely mechanical system. So essentially, I asked, well, what are they doing? So I tried to model what discretionary traders are doing. And in the process, I've developed a lot of exit strategies. Not all of them are in the public domain. But the idea there is that you want to think like a discretionary trader and model the approach of a discretionary trader. But you need to have a very specific algorithmic stop. So it's not a matter of opinion. It's been calculated based on daily data or whatever hourly data that you want to use. And then that gives you a very specific entry point. And then if you use multiple exits, you choose the one that's closest to prices. Sometimes it works great, sometimes it doesn't work great, but at least you have a systematic way of getting out of the trade. Or whether you're short or long, you need to have multiple exit strategies.
Let's see. Let me kind of ask you a little bit more here about a new trader. You kind of mentioned a trap a lot of new traders fall into. What do you feel is the biggest traps that new traders fall into when they get into trading?
Okay, so the first thing you have to realize is that not every trade is going to be successful. You have to think in terms of winning percentages and the average win-loss ratio. So if you look at, let me just say the first and foremost thing is, you need to be able to, for any trade, you need to be able to answer 3 questions. Do you know when you're going to get in? Do you have a specific rule for getting in? Second is, do you have a trade sizing? Do you know how much you're going to buy, like as a percentage of your capital or number of stock, number of, quantity? And the third is, do you know when you're going to get out? So you have to know those 3 things. So I think the one common mistake people make is they are reacting emotionally because they, someone on TV says that the stock is going to go higher, or you read on some, on some Reddit or someplace that the stock is going to take off. So you buy it. Okay, fine, you're in. Now, how are you going to get out? Are you waiting for someone else to tell you to get out, or you have some process of getting out? So I think the first thing that a new trader needs to do is they need to be sure that they know why they're getting in or where they're getting in. Then they know the size of the position, and then they know when they're going to get out. And then the fourth thing is they got to stick to it. You cannot. Another problem that many people have is they get unsystematic. So for one trade they use this, then for another trade they use something else, and for the third trade do something else. Now at the end of 3 trades, you have no idea what you actually did. And as a long-term trader, I can tell you that the market always is asking you, what do you believe? Like every day the market will ask you, what do you believe? And you can only trade what you believe. If you don't believe in something, you can't trade it. And so part of the problem for a new trader is they really don't know what they believe because they haven't traded enough, or they haven't done enough research or even homework. So I think what you have to ask the question is, what do I believe? So it amounts to things like, do you want to trade on the daily chart or the 5-minute chart? Do you want to trade this instrument? Like, do you want to trade an index, or do you want to trade a stock? Then what are your entry conditions? If this, and this is satisfied, I'm in. What's your trade size? If I'm going to buy 1 unit or 10 units or whatever the size is. And lastly, I'm going to get out regardless. But if I'm losing a position, I'm going to get out here. If I have a winning position, I'm going to get out there, and so on. So I think that, and then so the challenge is, can you stick to the same rules for 100 trades? And I tell you, 99% of the people will not be able to stick to the same rules for 100 trades. And that's why they don't necessarily succeed. Now, once you can prove to yourself that you can stick to a set of rules, once you have made them, now you can change your rules, because you don't have to stick to the same rules all the time. But it's very important to understand that if you are helter-skelter and just make random decisions, you're going to get random results.
Yeah. I really liked how you said position sizing, because I think that's an area a lot, like know when to get in, when to get out. But so many times people just are like, okay, well, I'm going to get in, so let's go big. And I just think that's a mistake in and of itself.
Well, look, the first thing you must recognize is that the markets are random. If you think that the markets are non-random, you're going to lose money. So Nvidia is a good example, right? It was at 140 whatever, now it's come down to whatever 100 or 101 or whatever the price is. Like, would you buy? Like, how many people would have bought a lot of Nvidia last year and held all the way, and they're still long, they're still waiting, because they believe that it's going to go higher? Or how many people were willing to buy on the open on Monday when it was down whatever 12.3%? I don't know the exact number, but it was down a lot. How many people actually bought it, and how many of them are still holding it? So the question is that, can you see my? No, you can't see mine. So
I shared my screen of NVIDIA, but we can try yours again too if you want to.
I am somehow.
I'll stop sharing so you can try.
Share screen, entire screen. Also share audio. Somehow the share bit is not coming out. I don't know why. Entire screen share. Okay. Share. Is it showing now?
Waiting. Usually takes a second or two.
Okay.
It's not showing yet, though. I think there might be something on with yours.
I don't know why it's not sharing. Okay, let's not worry about it. We'll just work off your screen.
Yeah, okay.
And video on your screen. That's fine.
Let's see. Share.
Okay. Yeah, somehow it said could not charge. I don't know what it's doing. So my point is that let's say that you bought in January of say you bought in January of 2024. Let's say you bought the breakout in January.
Right. Great time too.
And let's say you're still long, and then you went to 140 or whatever.
Right.
Now it's come down to, I don't know, 100, 103 today. Would you still be long, or would you have said, oh wow, I'm down, whatever, I better get out? And would you have, exited at all these different positions, or would you have bought it 5 times? And let's say you bought it here. Let's say you bought it here. It went up, now it's come down. Now, would you still be long if you bought it here? Say if you bought it on the first, say you bought it on June 24th, right? We have the first 3 days of the
Right.
sell-off.
Yeah. Okay.
So you bought it on the close. Now, would you still be long? Would you be, or would you be out of it? So those are the questions that you have to be able to answer, and that's part of your trading system, right? That's a part of how you're defining entries and exits. And the main challenge for people is, if you suppose you have a lot of profit in a position, then you say, let's get out, let's grab the profit. If you're in a losing position, you say, let's get out, but oh, maybe it'll bounce tomorrow, I'll wait. So the human psychology is that you're quicker to get out when you have a profit, and you're slower to get out when you have a loss.
Right.
So it magnifies your losses and cuts your profit, which is again why the top scholar idea is important, where we want to take our profit slowly but cut off losses at once, things like that. So it boils down to what do you believe. And I think one of the things I'd like to suggest to people is learn to do trading or testing rather, because if you're in a platform like MetaStock, you have wonderful testing capability. And whatever, and even if you take a very simple system like a 20-bar breakout with a 10-bar exit, the question is, can you execute it again and again and again for 100 trades? That's a different problem than saying that, oh, I'm long NVIDIA, it's going great, but I didn't get out and I'm terrible, whatever. So it's really important to have very clearly defined rules in your mind. And then the second part of the problem is trade sizing, as we just said. It may be easier for you to hold on to a position if you have a small size. Like, for example, on Monday, suppose you had, suppose you were fully in cash on, going into Monday. Would you have put 100% of your portfolio into NVIDIA at the open? I mean, maybe somebody has, maybe nobody has. But the question is, like, you have to have it ahead of time. You can't make this spur of the moment decision that's laden with emotion and think that you're going to get it right every single time. So rather than sort of rely on helter-skelter decision making, you're better off being systematic, and you're better off trusting your chart. So rather than relying on, someone telling you on TV or something you read on some whatever site somewhere, you're better off using something systematic. So, for example, if you look at the stochastic oscillator down below, when NVIDIA was trending, the stochastic oscillator was above 80, right? So you can say, well, it's above 80, I'm long, and then I'll get off on the 50-day moving average. Now that's a specific rule, right? It says I'm going to be long if the stochastic RSI rises above 80, and I'm going to exit on the 50-day moving average. So there's no hesitation on your part when it comes to execution. Now the question is that the best strategy? That's a different question. The question is, could you stick to the strategy and do it over and over again? Like, for example, Lilly is rallying today. So would you be willing to buy Lilly today if you just put up Lilly?
Yeah, coming.
Yeah. So, for example, Lilly bounced up today, right? Now, would you be willing to buy Lilly here, say on the close today, whatever the value is right now, and then say I'm going to hold it for another year, or I'll use the 200-day moving average at 725 or something. So I'll say, okay, I will hold it. I will hold it if it. I'll sell it if it comes back down to the 200-day moving average. And let's say Lilly keeps rising for the next 2 years and doesn't hit the 200-day moving average for 2 years. Would you be willing to hold it for 2 years, or whenever it comes back down to the 200-day moving average? So the point is that you kind of have to have a systematic process. Like here, for example, again, Lilly's trending. The stochastic RSI is above 80. Okay, you're long, and you're going to sell on the 50-day moving average. You would have exited, say, in June, or exited in late June somewhere. So again, the point is that you can have a very simple set of rules, and then it all boils down to which stocks are you trading. So you're back against the trend meter. If you could just add the trend meter to that. I don't know why if you just add the trend meter.
Mine does not, just because
you don't have trend meter here.
I'm in a temporary location right now. I don't have it here.
Really weird. I don't know why my.
I don't know why either. We can certainly try again if you want to. You had kind of talked about, so like I kind of pulled a couple things out of what you just said there.
Right.
Trading something very with discipline, can you do it? Can you repeat it 100 times before you make any changes? And then if you have that level of discipline, you're free to make changes. I'm curious what you would, how often you make changes to your methodologies and the way that you approach trading.
Yes. I've been a breakout style trader all my life. I've just used two types of systems. I've used a counter trend long buy or a breakout style long buy. So I mostly traded on the long side. When I was a money manager, I traded long shorts. I was indifferent, and I traded systematically for nearly 20 years without a single. So I made changes maybe once every 2-3 years as a systematic trader, and I stuck to it. But some of my systems I've continued trading for like 15, 20 years without a single change. I've taken every single signal, and that takes a lot of discipline. It's really, really hard to do. So now what I do is I've had a little change of strategy simply because I just gotten at a different point in life. So right now what I do is I'm still a breakout style trader. I still like to buy counter trend longs, but I've reduced. I just trade a smaller universe of only the major stocks, the Mag sevens or whatever, and then I basically I put on very large positions rather than very small positions. So when I was a money manager, my philosophy was a large number of small positions, whereas now my philosophy is a small number of large positions. So I basically have changed my trade sizing philosophy simply because I changed the mechanics of what I'm doing. Otherwise I've not really changed. I still prefer breakouts. I'm more of a position trader than an intraday trader or a very short-term trader, and that has its own frustrations. Like if you buy a breakout, you can have a reversal. Sometimes you look at, oh my God, who is the guy who got the highest high before it reversed? I'm the guy. And then there's a trailing stop, and who's the guy who got the lowest low and got stopped out before the market reversed? I'm that guy. So I've been stopped in and stopped out on the absolute high or low of the move dozens of times, but I've just gotten used to it. But
Me too.
start off, it gets very, very frustrating. So my suggestion is, think small when you start off. You can buy one share of Microsoft, just trade one object or two objects like Microsoft or Apple or Lilly, just the big stocks, and just see whether you can, just trade the same process over and over again, and then try to understand how system testing works, so you can test out different ideas. And you can start with very, very basic systems. Certainly, the trend meter is a very fine tool because you can use it to, and then also the swing system is also another very good tool if you want to buy counter trend. But again, you as a trader have to discover for yourself, what strategy works for you and what strategy you're willing to implement over and over again. I mean, you had Sunny Harris with you a few weeks ago. I mean, she's been trading on a 5-minute chart for like 40 years. So imagine she's done the same thing over and over and over with slight variations for basically forever. And that takes a whole different type of discipline and mental strength. And that's amazing what she's doing. So that's the kind of challenge you have as an individual trader. I mean, you can go and get her lesson, and I'm sure she teaches it very nicely. But ultimately, it's you, right? Can you stick to it? Would you be able to listen to her, take her lessons or whatever, and then do the same thing that she does for 40 years? I mean, it's not at all obvious that you can. So I think that is really the challenge that you or all individual traders have to discover. That is, what is the particular combination of rules that you're willing to execute over and over again.
All right. Can you think of any trades that have taught you a particularly important lesson?
So many of them. I just referred to them. I have, when I was a systematic trader, there were countless trades where I got stopped out and the market reversed. Whether I was long or short didn't matter. There was countless examples where I got stopped. I entered today and the market reversed the same day or the next day. And this happens to me even today because I buy breakouts, and sure enough, sometimes I buy a breakout and the market reverses. So the main lesson from that is you have to either say, I don't care and I'm just going to keep doing the same way and I'll get stopped out, or I will hold through the drawdown, or you got to say, I'm going to, I'm going to cry about it and get, very mentally upset if I don't get the absolute high of the move or the absolute low of the move when I enter or exit. So I think, those are the lessons. So the lessons are primarily, okay, let me put it this way. So whatever your belief system is, the market is going to challenge your belief system and try to convince you that you're wrong. So you have to every day reinforce the particular set of rules that you believe in and say, tell the market, I'm going to stick to this rule today and I'm going to stick to it tomorrow and I'm going to stick to it 6 months from now. And that's how you're going to be successful over the long term. So if you want to be a successful trader for the next 20 years, you got to be, you got to have a systematic approach. If you have an unsystematic approach, you'll get blown out.
Right. Maverick had a question about stops. So we're going to go back there if you don't mind.
Sure.
Maverick wants to know, he has actually two questions. The first is, how do you choose your initial stop placement? And do you ever use a hard stop instead of a trailing stop?
Yes, I always use a hard stop. So generally every single trade is a hard stop. And you can place them wherever you want. Typically, if you look at the swing system, I'm putting the hard stop at a 20-day low or a 15-day low or some kind of delayed offset low or a 15, or that's one place. I also have something what I call an accelerating stop, which is not part of the MetaStock package, but it's available in my package on TrendSpider. So I definitely use stops. I mean, of course, now this is on my trading side. On my investment side, I have a different philosophy. So I'm just buying and holding. So then there's no matter of a stop because it's basically a buy and hold thing.
All right. Gary makes a point, or Gary says that he doesn't feel like markets are totally random. There is random components, but over time, the S&P 500 always goes up.
Always comes up?
Always goes up. Yeah. Sorry, I can't talk very well today.
Oh, no. Okay. Okay, that's fine. That's fair enough. But the markets are random in the sense that you don't know exactly what the variation is going to be from day to day, right? So if you think of the S&P 500, it's gone up. The S&P 500 is the only market of any country that has gone up almost straight up for the last 100 years. If you look at the markets of other countries, they've had significant drawdowns. And even the S&P 500 has had drawdowns of 40%, 48% at different points in time. And when I say that the markets are random, you don't know, you can't predict when the drawdown of the next drawdown of the S&P 500 is going to occur. I mean, it has eventually come up, and it has come up because the U.S. economy is so fabulously, strong and has been absolutely marvelously resilient over the last 100 years.
In our lifetime, right?
I'm sorry?
Let's hope that is a trend that always continues in our life.
Yes, definitely. Yeah, there's no guarantee that trend will continue. Like if you look at Japan, right? Japan made a high in 87, and now it took 30 years or whatever, 40 years for it to make a new high. So it's not obvious. And if you look at the NASDAQ, it made a high in 2000. You had to wait 20 years or something before it made a new high. So the fact that the markets have gone up consistently doesn't mean that there are no non-random events in the market.
Let's see. We've obviously had a little bit of fluctuation, maybe this week.
Oh, yeah, sure.
Just a little. What do you feel about the markets where they're at right now? What are you kind of watching for? Obviously, like this can change any time. We're going to put a huge disclaimer right here. But would you say that you're still generally bullish through the end of the year?
Oh, yeah, I'm definitely bullish. I have a YouTube channel. If you do a search on YouTube, you'll find my various. I put up every week or so. I put up something. So essentially, my year-end target is 5850 for the S&P 500, and I think we are sort of. So typically, if you think of the 3 months leading into a U.S. election, they tend to be flat to down slightly, but there's so much variation in the market that if you just think of those 3 periods, so those 3 months are not necessarily different from any other 3 months on a statistical basis. But to answer your question, right now we're obviously in a downtrend. I'm thinking it's going to look something like the August, September, October period from last year, sort of a 5 wave down, if you want to use the Elliott wave analogy. It came down. So my downside target is around 5100, something like that. If on the S&P, if you're more aggressive, you can think of the 200-day moving average as a potential target. If you think of the October, if you just put a Fibonacci retracement from the October low to the high, you're gonna just put a
low to the high. You got it.
Yeah. From the October low to the our high of 2-3 weeks ago.
Just have to.
No worries.
Oh, okay. They're over here. Sorry. Okay, so from the October high.
No, from the October low.
Okay,
October.
right
Yeah, and then.
Okay. You want me to go right here?
Yeah, right.
Okay.
Right. Good. Perfect. So you see that we're sort of approaching a 38% retracement would be around 51. Will be around I guess 50. Yeah, about 5100 or so would be a retracement around, and then 50% retracement would be high. So it's quite possible that you can get down to a 38% retracement of that move, and I think that'll be pretty good support in that area. So that's sort of the area I'm looking at for a pullback region. 5100. The economy is pretty good, and the Fed will start cutting rates. So I don't see any reason for the market to go dramatically lower. And this is a normal pullback. A 10% pullback will also put you in the general area of 5100. So I think, or I guess 510, if you think of it that way, on the SPY.
Right.
So I don't think it's so. I think this is just the summer correction. If you look at if you look at July of last year through October of last year, we sort of have this, 5-wave correction down to the October low. So I'm expecting that there's going to be a significant low just before the election. And if people want to wait for it or have the patience for it, they should definitely buy the October lows this year. And they'll be very happy when we get to December of next year, because we'll have double-digit returns into December of next year, starting from the October low of this year. And I'm expecting 58.50. That's my target for the end of the year. We'll see what happens.
That's interesting. That's the second time somebody's brought up the October low. Well, to me anyway.
I mean, it's fairly typical. That's there's always election years. So you have to be a little bit careful with patterns, because if you actually look at the weekly data or monthly data for the S&P 500 going to 1950, you cannot statistically see a massive difference between the 3-month period, August, September, October, or any other 3-month period. Basically, very, very similar. But because there's so much noise and variation in the market. But just as a practical matter, there's always some nervousness ahead of an election every year, and the market has seen 40+ cycles, so the market is quite used to it. And then there's generally always regardless of who wins, there's always a rally into the first 18 months of the year. About the 14 months leading up to the December of the first year of the new administration, or the second term of the current administration, whatever. And so I think it'll be a fine trade to buy the October lows, and maybe the lows will be in September. I mean, it can be in early October. So there'll be some variation, and then the Fed will start cutting. So then there's the whole question of how many cuts and this and that. But between now and the end of next year, the Fed will have cut at least 3 or 4 times. So the economic conditions will be significantly favorable. I don't know who's going to win, but the new administration, whoever they are, will have their policies, whatever they will be. But the market has seen so many election cycles, they simply don't care. They look at the macro performance, and the macro performance is pretty good. If you look at the smooth recession probabilities, SARM rule is the only thing that is now signaling potential recession, simply because the unemployment rate has gone up to 4.1, 4.2% area. So I think the market conditions will be favorable, but it'll still be random. People will still try to you really have to manage your emotions and say. So think of last year's July, August, September, October period as your reference. 5100 on the downside as a target, October low as a target, and if you buy, even if you buy on the last day of October, regardless of what the value is, and hold it through the end of, say, December of 31st of next year, I think you'll have good returns.
Not a recommendation.
Yeah, it's not a recommendation. We're just guessing. I mean, I could be wrong.
That in there for the lawyers. That's all.
So I could be wrong. I'll be happy to. I'll be the first to say that. Just patterns, that may repeat and have repeated in the past, or have repeated in the past.
What do you do for fun? Like, what do you do on your off time when you're not looking at the market? So, what are some of the hobbies that you've got, Tushar?
I love growing fruit trees. So.
Oh, really? Okay.
Yeah. And cool. I love making ice cream. So I'm a very good ice cream maker.
What kind of fruit trees do you have in your orchard?
I have I have a much smaller. Well, if I integrate thing, I have peaches, I have pears, I have plums, I have apricots, I have figs, I have lemons, which are not a fruit, but nonetheless, or not a tree per se. But I have figs. I just had some fabulous figs and cherries and berries and whatnot. So I love fruit trees. Once upon a time, 1 year I had 1,200 peaches.
Oh wow! Okay, how many trees is that? Do you think?
Lot
Like
of
just
them.
for
I don't
record.
have. I had about a dozen trees, a dozen fruit
Okay,
trees, and I got
1,200 peaches.
hundreds and hundreds. I mean, like I had 2 plum trees that gave me thousands of plums. I mean, I don't have them now, but I had them. I'm gonna, I've downsized my garden just to make it more manageable.
Yeah.
But
I get it.
I love fruit trees. I love music. I do some traveling.
What kind of music do you like?
Pardon me?
What kind of music?
I mostly listen to Indian classical music. So all of the the modern music that my kids listen to. I'm rather stupid that way. But if I can't understand the words that are being sung, I can't follow the music.
Sure.
Most of the things like rock and so forth, I don't understand what they're singing. So I'm rather stupid that way. But if I can't follow the words and the lyrics, I can't follow the music. I love classical music. I try to go to a concert as much as I can. I love Vivaldi is one of my favorite composers. I like jazz. I've been to so I like this I like happy music. Let's put it that.
Cool. What how can people get in touch with you? Like how if do you have a place that you'd want them to go to be able to keep in touch with you? Like you mentioned your YouTube channel. I'm going to find it real quick.
Yeah, you can go to my YouTube channel and leave a comment or question. I'll try to answer it. I have a Substack. Substack is sort of I've tried putting videos on Substack, but apparently people still want the written word rather than videotape. So writing takes a lot of time. So I generally don't want to write anymore because it takes more time than I want to invest. And then
let's take a picture of you on your YouTube channel. Here we go. I found it.
Yeah.
Now if I can find my way back into the room, let's see. Here we go. All right. Here we are.
Yeah,
we'll include that in the YouTubes that we put up too.
Yeah. You can you can also send me admin@chandeindicators.com. That also works. But in general, I generally am lagging in my responses simply because sometimes the answers are too specific and it takes a while to get a good answer.
You're always very fast in my experience. So thank you. All right. I do want to say thanks for spending some time with us today. That's awesome. Appreciate it.
And well, thank you for inviting me. I hope people found it somewhat interesting.
I did.
So anyway. An audience of one. I win.
Yeah, awesome. Thanks a lot, Tushar.
Right. Thank you. See you soon. Done. Thank you, everybody. Thanks for coming by.
All right.
Bye.
Bye.